welcome. This is the Financial Thought Exchange podcast, where you get a little wiser by learning from the leading thinkers in finance. I'm your host, Lotta Moberg, and today's guest is Mike Dowdall. He is Chief Investment Officer of Alternative Fund Advisors and the portfolio manager of the firm's Private Credit Fund. So perfect person to talk about alternative credit. And he's responsible for the fund's investment sourcing, due diligence, and positioning. So welcome, Mike.
Thanks, Lotta. Great to be here.
Now, you contributed to our book that is coming out now on alternative credit. This is in a collaboration between the Research Foundation and the CFA Society New York. It's a great piece overall, and you wrap it all up by talking about the future of alternative credit. So that is what we're going to be digging into today. Maybe we'll start by just giving the listeners here in our audience an overview of what you think are the main contributors here going forward for the future of alternative credit that is going to boost the growth of this space.
Yeah, I mean, there's a number of dynamics going on, and a lot of these aren't new. It's been a culmination of these dynamics, and it's really particularly come to a head over the last 5 years. So the first thing I look at is demographics. We've got an aging population that's in the U.S., that's in the rest of the world. So from that standpoint, you have more demand from fixed income, whether that's public or private. That we'll see how that all shapes up. But there's going to be growth in that fixed income area of the market. So the demographics really are driving that broad search for income, and particularly high income, and that's what alternative income sources tend to provide. The other thing you've seen as well, you've seen a privatization in the stock market. So the number of listed stocks here in the U.S. peaked in the mid-90s, came down a lot, and has really flatlined since the global financial crisis. So from that standpoint, you've got a lot more private companies that are out there. And because there's more private companies, there's more demand for private credit as well. A lot of these private companies don't want to have to go into the public credit markets, have to disclose all this information. They prefer not to. And a lot of them are too small to access the public credit markets as well. So you've got those two. You've got technology. That's really been, I think, a great equalizer. So if you think back to the early days, or even 10 or 15 years ago in the fixed income market, it was a very manual process. You needed to have large teams to go out and do the sourcing, the due diligence, the underwriting, and then the servicing of these loans. With technology now, that's really equalized a lot of the market, so that these smaller, more nimble teams can now do a lot of these same activities with just a much smaller footprint. And then the last thing, which I think is probably the most important, has just been bank retrenchment. So there's been a number of regulations post global financial crisis in particular, and even more recently as well. This just made it a lot harder for banks to do anything really outside of this small, the small kind of box, credit box in which they can do. So that's pushed a lot into the private credit markets as well. And then the other thing as well is just the broader regulation has made it more expensive to run a bank. So there were 14,000 banks in the U.S. in 1985. Now there's somewhere around 4,000. So there's just much fewer banks, and the banks that were made tend to do larger loans. So that bank retrenchment has really been a strong story. A lot of these smaller borrowers need a solution, and that's really where alternative credit has stepped in.
That's interesting. We'll dig into some of those areas as we're pursuing this conversation. One that you mentioned, companies choosing to stay private for longer. So that is interesting. What is driving that? Is that regulation? You mentioned the disclosure. Is that the reason why companies are choosing to stay private for longer?
Yeah, I mean, I think I think that's part of it for sure. Is on the regulation side. It's expensive to be a public company, and the other factor as well is there's a lot of money in private equity as well, and so to the extent that you don't have to go public earlier than you want to, or really at all, a lot of companies are just choosing to stay private. So that's really caused, they then need credit as well. And so when they look to credit, they're going to look typically to the private markets as well to gain that.
And then it's on the access side that you mentioned too about the technology. So is there today, if I am an investor and I want to be I have my savings here, I want to put this into alternative credit. Is there any easy solution by now that is such as an ETF that you can get exposure in that way? Or do you have to go to more these higher tech routes, so to speak?
Yeah, so it depends where you want to go on what I'd call the liquidity spectrum. So there in alternative credit, there's things like CLOs. So CLOs, it used to be quite hard really to get exposure to CLOs and really pure play CLOs. Now there are ETFs that are out there that you can get exposure to CLOs. If you think about like broadly syndicated loans, so these are loans typically to private equity sponsored businesses, but they tend to be larger. There are ETFs out there. So there are ways to access what we call closer to passive type investments in the private credit space. That's on the more liquid side of alternative credit. If you go to the less liquid side, it is much, much harder. And you really can't get what I'd consider to be more passive exposure, because the issue is that the companies originate the loans and then they hold them in their funds or on their balance sheet or wherever it is. And so from that standpoint, it's it's tough to then get a essentially what you'd consider to be passive exposure if it's being held in these funds that have drawdown periods, are tough to access, are capped at certain amount of investors. So really, it depends on where you want to go in the alternative credit space. But I think that is something that you're going to continue to see innovation in. People, there's been the whole race to passive in equities, and that's played out at this point. There's no reason why it doesn't move down a little bit into private credit. I don't think it's going to ever get to the same level because of the bespoke nature of private credit. But I could see there being a greater push to figure out new product innovations to provide more of that quote unquote passive exposure.
So if we think about what we have accessible today among those innovation, you discussed in the piece that you wrote for us about digital lending platforms. I bet most people have not heard about that. I had not before reading it. Maybe you can give an overview of what these are, how do they work?
Yeah, so digital lending platforms really came out. Again, we're talking, and you'll notice this trend. A lot of things coming out post global financial crisis, and so where that started, they used to be called peer-to-peer lending. And so what you had is groups like Upstart and groups like that. And what they do is they would, someone would go and apply for a loan, and they would, it's usually these personal loans. It might be kind of a paycheck advance or something along those lines. Then you would have investors as well who could just be regular people like you or me, go and then invest in some of these loans themselves. And so it essentially provided that marketplace. Now that peer-to-peer side has kind of died off, I'd say, over the last few years. Performance was okay. There were some issues around who had first dibs on some of these loans as well. But what's come up out of that is that you now have these certain platforms that have come about that also try to essentially disintermediate. And what they'll do is the platforms themselves will essentially act as the agent on the loan, in that they will originate it. They will then service it as well. But then the investors or the lenders are essentially crowdsourced. And so it's people can go onto the website and then be able to participate in that loan themselves. Now you need to be very comfortable with the technology firm that's doing this. Sometimes they're very good technology firms. They may not be great credit underwriters, but sometimes they are. And so you need to be able to have some comfort there. So I think that technology, it's always looking to disintermediate. And I think that is one new frontier that we've seen for it. I don't think that's going to take over the alternative credit environment, because again, you need, from the investor side, you're going to want to have some sophistication. you're going to get these loan docs. You want to make sure that you're reading through those loan docs and understand what you're actually participating in. Not everyone wants to spend their Saturday morning reading through loan docs to then participate in this loan. But there's going to be a subset that is. And so the more sophisticated investors that want access to alternative credit, I think that's one area that's going to grow over time. Those who don't want to do that, there's other options out there that they can go into. Most likely they'd go into some sort of a fund where they're paying someone to really do that work for themselves.
Right. So if anybody has invested on the equity side, then in a crowdfunding platform, it will be a similar experience then. Just this is lending instead of equity investing.
Exactly. It's quite similar to that. It's crowdfunding at the end of the day.
And it does require, from what you're saying, that the investors do their due diligence. It's not like a fund where the fund managers have done a lot of the due diligence for you.
Exactly. Yeah. So you do have, you can rely upon the platform for they do their own due diligence.
Okay.
But I'd recommend they also do your own to make sure you understand it.
Right. Because if you're thinking about, a lot of people will be familiar with private credit from a fund. So I'm an LP, a limited partner, and there's a GP, the general partner, and they have an incentive to have great performance because they get a great carry, that is the performance fee, and then they have the management fee. But here, the platform is more like kind of a broker, right? Like a mediator facilitating it, but they're not actually taking a stake in the middle there.
That's the way I would look at it. It's more of a broker. Okay. Yeah. So, do you trust the broker? I'm always a trust but verify. So I would say, maybe, make sure you understand what you're getting into before you do, because again, it's a liquid. If all of a sudden you decide you don't want to be in there again, it's going to be very tough to get out of.
Yeah. So good warning there. Worth checking out maybe, but as you said, they're in a bit of decline. What would you think is the reason for that?
Yeah, so I'd say that the peer-to-peer side, like the consumer lending, is in decline. I'd say I'd almost call it, it's a little bit of a different flavor in that you're doing larger transactions. There's more data that you have behind it. That's actually been growing. And I think that that's something that will continue to grow, but it's going to be for a certain subset of investors. And you need to make sure that that you're in that subset and you consider yourself more of a sophisticated investor.
But do you need to be an accredited investor?
So it depends on the vehicle. Typically, you do need to be an accredited investor, but it depends on how they've structured it. There are some structures you can do where you actually would not need to be an accredited investor.
So a lot of research required there to
yes.
Participate more than it might seem. You mentioned also the business development companies, or BDCs. That is something that is probably new for most people. Maybe you can give an overview there. What it's a kind of publicly traded vehicle. So maybe you can explain how these work.
Yeah, I mean, BDCs have been around for decades here in the U.S. They've really become, I'd say, more popular recently. But essentially, what they do is they're set up where they provide loans to small and medium-sized U.S. companies, and that's really what the regulation is built around, is to ensure that money is getting to the small and medium-sized businesses. Now, those businesses can be owned by private equity. They can be, what we call non-sponsored. It depends there. BDCs, they have both a public flavor and a private flavor. So the public BDCs is maybe what some are more familiar with. There are a number of multi-billion-dollar BDCs that are out there that you can just go and buy in your brokerage account. Now, the one downside that you have with those public BDCs is that they're going to be pretty volatile, and the reason being that they're publicly traded. And so what you have is you have their assets, which are loans, and then you have the price, which moves around as well. And so essentially, if there's a lot of volatility in the market, the assets might not actually move around that much in price, but the price of that BDC might move around a lot, just like the stock market. Private BDCs, and I know we'll get to the valuation in private credit hopefully as well. And so on the private side, what you have is it's like a private fund. You usually submit a subscription document to them, and then you're in. It's going to be much less volatile. So private assets tend to be less volatile than public assets. So that would be one potential benefit for investors is the lack of volatility. The other thing to know with BDCs is that they tend to use leverage. And I think that's something that investors should be very aware of in the private credit market is where leverage can creep in. In the BDC market, they're able to use 2-to-1 leverage. So 2 units of debt to every 1 unit of equity or investor capital that's in there. So these can be relatively levered investments. So that's another thing that when you're looking, if you're looking at the BDC market, I'd suggest that you get comfortable with the leverage within there and the amount of leverage that are in certain BDCs. Now that can definitely boost returns, but just make sure that it's done in a prudent manner.
But if we're thinking about the lower volatility in this context, a lot of people may be familiar with how in the equity space, private equity will have lower volatility, but it's behind what is commonly recognized as kind of a veil. Like you don't see the volatility because there's no reporting, because there's no information, you won't have the volatility, but the underlying value will be like the fundamentals will be fluctuating just as much as they're fluctuating and possibly even more, just as much as they're fluctuating for public companies. So here, equivalently in the lending space, is it not the similar thing that we're looking at? If you're saying a person saving for their pensions and saying you should do the private rather than the public because the private will have lower volatility, are we actually helping people out here to seek the actually lower fundamental risk?
Yeah, no, that's obviously a hot button issue in the private space. Let me provide a couple ideas there. So in terms of the private space, it is in fact slow to move in terms of the pricing. It's just the nature of the private markets is that a lot of people go to them for certainty and ease of execution. And from that standpoint, it just doesn't move as quickly as the public markets. It doesn't mean it doesn't move at all. It definitely does. Pricing definitely does move there, but it's a much slower process. So that's the first thing I'd note there. The second thing is, well, and to eliminate that, one thing we always discuss when we're talking about that is it's a little bit of akin to the idea of REITs versus your home value. So your home value does change over time. There's various factors that will change it. It's spring selling season. It can be things like changes to the neighborhood. It does change, but those tend to be slower moving dynamics. But you do see in the REIT market that whips around a lot more, and so you can see the REIT market down 10% in a month doesn't necessarily mean your home price itself is down 10%. Now that does provide you a signal that there's something maybe happening in the housing market, but it's just I'd say the broader stock market tends to have more volatility than maybe some of the assets on the ground. So from that standpoint, I think that again underscores the fact that private market does tend to move slower. Now, on the private credit space as well, there's also the idea you either get paid back or you don't. And so there's kind of there's a day of reckoning there that maybe is a little bit different than the private equity space, which has much longer time frames, and because it's equity should be more volatile than debt as well. So on the private debt space, I get it. Like there's questions around, should it be marked up 1 or 2 points or marked down 1 or 2 points? But at the end of the day, these tend to be short duration loans, and you either get paid back or you don't. And so from that standpoint, there's essentially this point of convergence where you need to get paid back or you need to take a loss on that loan. So from that standpoint, I think that the valuation question on debt, it's a little bit less so than a little bit lessened than maybe on private equity.
Yeah. If we're thinking about other riskier, on the risky side, bonds, we had a high yield, and there you got the high yield public bonds, public companies bonds, that high yield, also called junk, but high yield because it tends to have a high yield. How would you compare, if we're thinking about the risk profile there, risk versus return? That might be the closest in the private space, right, to compare to alternative credit.
Yeah, no, that's right. That probably is. I mean, just a few maybe data points out there. So, a law firm called Proskauer Rose tracks defaults in the private debt space, particularly in middle market direct lending. Again, these tend to be private equity sponsored businesses that you're lending to. And as of Q3 2023, the default rolling 12-month default rate was somewhere a little bit under 2% on that direct lending. Relative to the high yield space, high yield was around 3%. So direct lending default rates were just a little bit lower. On the recovery side, that's something that I think that investors should look at closely as well. Is what are the recoveries when the defaults occur? Because you can have a high defaulting portfolio, but if the recoveries are there, you do just fine from a return perspective. So recoveries on private credit, it ranges, but in a middle market direct lending, cash flow lending, that's your kind of bread and butter, private credit. What you'd expect to recoveries in the event of default is somewhere around 70% for that space. Whereas in high yield, you're usually underwriting to 30 to 40% recoveries, and that's usually where it's been historically. So you've seen recently lower defaults in direct lending. You tend to see higher recoveries in direct lending. So from that standpoint, you'd say that direct lending is potentially lower risk. The main caveat I'd put there, though, is that alternative credit is not a monolith. There are so many different areas of it. There's mezzanine financing, there's venture capital lending, there's all these other areas. And I couldn't stand here and tell you that those are lower risk than high yield. So I think you need to understand when you're going into alternative credit what you're going into. There are going to be areas of alternative credit that I do believe have similar to potentially even lower risk than high yield. And there are going to be certain areas that have meaningfully higher risk than high yield. So it's just a matter of understanding which area you're going into and understanding the risks that underlie.
As a part of this series, we're picking out a couple of specific areas in alternative credit, and we will be digging deeper into one, infrastructure credit. Mm-hmm. And that might be on the extreme side of a safer and higher recovery possibly. And then we'll be talking about the venture capital on the other side, which might be what most people are thinking about and might be surprised when they hear that it's not very risky, because they might be coming across startups raising capital and many of them defaulting altogether. But it's important when you're talking about a recovery. I think many people, when they think about a default, you think about, I put money in, it disappeared. The company went belly up, so there's nothing to do, and 100% is gone. But what happens, right, if you default, it all depends on seniority. Right? So in this context, you'll have, if you're a senior investor, you might get a lot of that money back. There'll still be cash, even if the company goes completely belly up. There's still some assets there, and it depends on who gets to claim those assets, right?
Exactly. Yeah. Seniority. A lot of it as well is, I think that, and this really defines, I'd say, the good private credit managers from the great ones, is the ability to structure the loan documents to ensure that the recoveries are there. And so what that means is having the covenants in place to basically be able to step in before all value is lost, and step in, be able to, whether it be force a sale, liquidate assets, whatever it may be, but really stem the bleeding to ensure that you can get that recovery. And you need to do that at the outset. You need to make sure that that's in your loan documents, that all these loan documents are bespoke. So having the right covenants in place, and then monitoring and servicing and ensuring that you're there to enforce when you need to. That's really important.
So when we're thinking about the risks in this space, I feel like a lot of the attitude, which I think it's not incorrect, is just you can't really say much about risk because they're all different. They're all different companies, and this startup versus that startup or this infrastructure project. We've been touching on this a little bit, but when it comes to, I think you could have said that 100 years ago about public stocks too, right? In terms of like, well, they're all different, so we can't say anything. Risk model, what could that possibly be? But what are you seeing? What are you seeing in terms of development in the space of understanding risk, like modeling the risk of alternative credit? What are you seeing now, and what would you foresee might be happening in that space?
Yeah, I mean, I'll tell you, alternative credit risk modeling is I'd say behind a lot of the other areas, and some of that's because of the structure. I'd say that a lot of risk models are time series dependent. But if you don't have a great and clean time series, because really, it's the industry's really grown a lot over the last couple of years, and it's changed and morphed. So the time series tend to be short in nature. So that's something that the industry really deals with, is the fact that they don't have that great time series to be able to back test against. So I think that's one area that's really I'd say slowed down the growth in risk modeling. The other thing as well is, again, the loan documents are very bespoke, and that doesn't lend itself very well to off-the-shelf credit models. When you have these very bespoke covenants, you can have venture. You mentioned venture lending, and they have very bespoke covenants within that space. It could be around revenue growth in one segment of where they're lending into, and that can be very important from a risk management standpoint. But it's tough to model that in if you just have off-the-shelf software. So what we've seen is a number of groups have started to do their own software really by themselves, because they've got frustrated that there really isn't a lot of great off-the-shelf software right there. One area that we have seen, and I think you'll continue to see innovation in, is around large language models and being able to scrape a lot of the loan documents and be able to model some of the covenants as well. So I think that's one area that you're definitely going to continue to see growth in. It makes sense. A lot of what's done in private credit, it's qualitative, and really the goal is to be able to take that qualitative knowledge and that qualitative underwriting and then translate it into the quantitative. And we're really in the early innings of that right now. But there's no reason why that should be further along than it is right now. And I think that it will be in the next few years, being able to translate that into really robust credit models.
So when you'd set up a model like this for a human to actually understand, you would maybe come up with some kind of matrix where you're seeing sense of recovery probability or like assurance of various things that come out in the covenant, and somehow you then with a human then take those metrics and put it in a more classical model? Or would you just leave it to the AI maybe and say, just tell me, just give me a score, how risky is this? And it becomes more kind of like a black box and you don't really know what factors it's using.
I mean, I think there could be a combination of the two. I mean, I think there's certain things like, what's the value of a covenant? And not to get too philosophical here, but essentially, what's the value when you're trading off with your borrower? You need to decide what's important, what's not important. Right now, that's really all qualitative at the moment. But there is, in fact, there should be also a quantitative answer to that. How much is it worth to have these maintenance covenants in place relative to the odds of default, and what does that mean on the path to recovery? So I think that's something that does translate into maybe a more human understandable interface there. But there also is the idea of the black box, where you can just kind of run it through, look at what has occurred, what loans have done well, what have done poorly, what are the loan documents that were in place when these loans were originated, to get an understanding then of risk scores and probability of default as well. That's more of I'd say a black box output there.
So one part of risk model would be, I want to take on this loan, or I want to invest in this loan, and is it a good idea or not? And therefore I do my risk modeling. The other one is, I have this loan on the books. Do I want to sell it or not? If there is a market for it, should I maintain this position? Should I add to my position perhaps as well? So that's more the ongoing one. And as we've been talking about, the transparency, it's very opaque. You don't get very frequent updates. You may if you were in a private credit fund, event once in a while, right? You can maybe call up a company and say, like, what's going on? Can I look at your financials? I'm an investor. But is there anything that is moving in that space, that transparency and more frequently updated numbers to get from companies so that you can get this ongoing risk modeling as well?
Yeah, I'd say that there is a big push right now for more transparency. I think one of the issues was that the growth in private credit, a lot of it occurred around the structure, the private equity structure. So this drawdown fund, and then it's closed end. And from that standpoint, that is not a structure that tends to lend itself to transparency, because the GPs have very little incentive to provide transparency, because you provide a commitment and then you're in the fund. And so from the GP standpoint, well, we've got the capital in, we'll provide some transparency, but what's our incentive to provide a lot of transparency there? We already have, essentially, we've got your money in the door. So that has really been a lot of the growth there. What we have seen, though, particularly over the last couple of years, is that there is more of a shift towards what I consider to be evergreen structures, where there is the ability to get out. And that makes it that every quarter, or whenever the redemption periods are, the investor has that ability to get out of the fund. And so from that standpoint, there's going to be, I'd say, a lot more incentive from the GP to provide that transparency and get the investors comfortable around the investments to avoid redemptions. So I think that has aligned the incentives a lot more. We have seen a lot more transparency that's come about. Whether that's because of the structure or not is who can say, but the transparency has gotten significantly better. Now, I think as LPs, you're always looking for more transparency. You always want to be able to know more about the portfolio, but there definitely has been a lot more alignment that has occurred over the last few years.
It sounds like even in the absence of a liquid market for this, it sounds very myopic for a GP not to want to provide a good after you sold it. It's a little bit like, I sell you a banana, like, what do I care if it's empty? Well, you care because everybody else is going to tell everybody else. You're going to get a great reputation if you're the one who comes out with the updates and talk about the companies. And that's my experience. And you get more people on board. The people who are already on board want to put more money into it and so on.
Yeah, no, that's definitely... I'd say the industry's definitely moved that space. I mean, it's not that big of an industry. Reputation is very important. And going in now, I think a lot of LPs are a lot smarter. They're going to ensure that the transparency is going to be there before they write the check. So that's a big part of it as well, is negotiating, setting those expectations before you even go into the fund, that you're going to get what you need. Because then once you're in, you lose some of that leverage. And so that's a big part of it as well. And what you've seen as well is transparency has now become the expectation relative to it being, something that you're just happy to have. So now that that's become the expectation, the bar has definitely been raised, and transparency has definitely increased.
So we're taking only the side almost of the positive of this space and all the growth potentials. What could be some of the threats to the growth here? Like, is it after the races? It's just going to keep growing. It has been growing for a good while. It is certainly an expanding space. What could there be a setback? I kind of feel like we don't have a history that is long enough to understand under what environments private credit would decline, right? I don't think, and correct me if I'm wrong, that it's ever declined. It was so small during the financial crisis, and the regulations there, as we understand, that kind of just that made it take off, actually, if anything. So what could happen? What could be like a macro environment or other things that could threaten the growth of the space?
I think you're totally right in terms of the length of track record. So, I mean, it was around during the financial crisis. There's indices that have tracked it. It put the industry down about 8% during the financial crisis, but it was so small and it was so different that I'd put a lot of caveats on that. So I think that really the main threat to the industry right now would be the fact that, if we go into a recession, it doesn't perform as well as it's built to perform. I think that's really the main one. It's investors, personally, I think rightly, but we could be proven wrong, view it as a relatively defensive asset class. And to the extent that doesn't hold up during the next recession, that's really, I think, that the major threat right there. I can tell you anecdotally, to the extent that the COVID shock could be considered really a downturn. There was some stress that was in the market. Now, what was, I'd say, heartening was that because a lot of these loans are bilateral in nature, we did see some really good engagement between the lenders and the borrowers, figuring out the path forward here. And I think that is an advantage of private credit, is that you do have this relationship between borrower and lender. It's not this large syndicate. It's not these nameless, faceless people that hold a bunch of QSIPs, where it's a lot harder to, say, waive a covenant for a quarter or something like that to ensure that the business is able to continue on. And so, that I think that was a small test case, and private credit did pretty well during COVID-19. So that's fine. But an extended, longer drawdown, I think that's really where we need to see the asset class perform. One other area I'd say that could potentially be a threat is regulation. So right now, private credit has very little regulation, and that is, from that standpoint, it's helpful. They're able to run their businesses a lot cheaper than the banks and other lenders that are out there. So to the extent that regulation starts to maybe impede in those businesses, you potentially see the cost of capital on private credit can't do loans that they used to do anymore because it becomes too expensive. So I think that is another area, and then maybe that some of these loans get kicked back to the banks or go into other areas of the market. So I think that is another risk that's out there. So far, the regulation that has been proposed for the industry has mainly been focused on those largest lenders, the ones that are managing tens to even hundreds of billions of dollars in private credit. So that's that could be. But to the extent that it moves down market, there's a lot of these smaller private credit managers that just don't have the margins and don't have the ability to really operate where they have significant burden around regulations.
Right. So for the purpose of regulations, one is systemic risk and the other one is protecting the ultimate consumer, right? The investor. Mm-hmm. So it sounds like what you're saying is regulations have completely focused on the former, the systemic risk part.
Exactly. Yeah. I mean, there's plenty of regulations on the latter, and private credit firms and alternative credit firms have comply with those, and that's not an issue. It's more on the former, though. To the extent that there's more that gets pushed out of the banking system and into the private markets, it just goes without saying. There's regulators are going to take a closer look, and so what that regulation looks like, who it targets, I think the jury's out on what that's going to be right now. But it's hard for an industry to grow like this and not have more regulatory scrutiny. So I think that's coming up.
Yeah, there was a while back quite a lot of talk about shadow banking and the dangers of that and all of that. And kind of died down. I don't know why, because this would be part of what people would call the shadow banking space. Maybe they figured out that there wasn't any really systemic component to it, so there's not really anything that you can kind of try to shoot down here. I don't know if you have a bit more color on that.
Yeah, I mean, I think they're to the extent that it's largely outside of the banking system. It doesn't mean that the banking system's not involved. A lot of times you'll see the banking system involved in private credit and alternative credit, mainly as a senior lender in there. But they're going to be typically more secured. So because it's not mixing, mom and pop deposits with riskier lending, I think it's gone to pass so far, or at least been treated a little bit easier. So yeah, there was a lot of talk really on that shadow lending space and the securitized products market and all these other areas. But yeah, it really has died down. Now these things tend to pop up again when there's something bad that happens, and whether it's the GFC or something else that could potentially happen in the future. That's where probably these discussions start to pick up again.
So one aspect of this space that people tend to like a lot is the ESG aspect. You mentioned this a little bit. It would be interesting just to hear about how that works in this space. What does ESG mean in alternative credit? Does that mean lending to ESG-oriented companies or something different?
Yeah, that's an area that's definitely in its infancy as well. We talked about technology being in the early innings. ESG in alternative lending as well is in the early innings. What's nice about I think it's a great asset class if you're really looking to make an impact is the fact that it can be really targeted. So if you have just these really important areas that are important to an investor or just a person, they're able to really micro target it in private credit, because loans are a lot easier to do than equity investments. So from that standpoint, you're able to go into areas, whether it's just it might be things like animal rights, and you can just go in and provide loans to certain segments that might have a tilt towards animal rights, or that might be all that they do, and you can provide loans there and help them grow and scale. The other thing you can also do is you can write the loan documents exactly how you want to write them. So it can be things like ratcheting down the interest rate if certain ESG goals are met, or providing the next tranche of lending, again, if those goals are met. So I think that it's a really interesting asset class. If that's your interest is ESG, you can provide these loans. You don't have to take an equity stake. You're just someone that helps a business scale. And you can even write them that potentially the principal could be reduced or even waived if they meet certain goals as well in there. So I think that's an area that really the surface has only been scratched in terms of being able to integrate really true ESG into private credit or alternative credit. I think that will continue to grow. Now, also you can do in private, in private credit, all of the typical things you can do in your typical ESG. Do all your scoring and be able to the typical ESG investment. That's also something that's able to do. Again, some of these businesses are more opaque, so it's not going to be as easy necessarily to do, but it is doable. But I think really the secret sauce for private credit and alternative lending is really in that impact space.
It is fascinating to think about all kinds of values that one ends up expressing possibly with your money. If I think that health is important, or I want the health score of your employees, or do blood work on them or something like that, or even it probably wouldn't be legal, but I could say if you're contributing to this political candidate that I really like to win with your whatever work you do that somehow favors that person, like it can be really intricate, right? You can express your kind of values and wants in different areas of life.
Exactly. Yeah. I mean, if you read through some of the the loan documents that are out there, you can see the amount and the variety of covenants you can have in these loans is endless. You can have whatever you want in there, as long as you and the borrower agree to it. So you really can make it, you can structure it however you want. You can put whatever you want in there and ensure that you're aligned. And, to the extent that that's something that's important to you, you're usually going to see that the borrower, if they're going to take your loan, it's important to them as well. So it's something that you can really build in there in the line.
Well, that's interesting. Oh wait, so let's talk about the really exciting part of any bond, which is the spreads and the interest rates here. If we think about spreads in this context, how would we generally define it? Do we say kind of over a prime rate? And is it kind of a stable spread that we're seeing? It doesn't move much of that. If the prime rate goes up, the spreads remain the same. This is higher interest rate environment. So does that mean that yields have gone up to the extent that, say, the prime rate and such interest rates, the low risk rates have gone up as well?
Yeah. So typically these are broadly floating rate in nature. There are some fixed rate out there, but think about it as mainly floating rate. There's going to be a base. The standard base rate is SOFR. At this point, we used to be LIBOR, which has hit the dust heap, and then a spread over it. And what you'll see in private credit, in particularly like middle market direct lending, it's a relatively efficient market in that the spread relative to the risk is relatively well known across the market. Now, what's actually in the loan documents then and the covenants, that varies more so. But really the spread that's in there, you're going to see something that in today's market is somewhere around SOFR plus, call it 550 to 650, or somewhere around there at the moment. And that's again in middle market direct lending, which is the largest part of private credit. Now, if you go outside of that, if you go into other areas of the market, like your VC lending, like your asset-based lending, especially finance, you're going to see a lot more divergence. There's going to be, again, they're usually going to be floating rate in nature, but you can see spreads that vary significantly depending upon the risk and the sourcing and the underwriting and all these other factors that go in there. So when you think about rising rates, rates will rise with what the Fed's doing at the front end of the curve because these are, again, floating rate in nature. Now, what we've seen is as the Fed has increased rates over the last, what has it been, 18 months or so right now, is that what you run into with businesses is that you hit a point at which you really can't raise rates anymore on the loan. The limiting factor there for a business is their marginal return on assets. If their marginal return on assets is not above their lending rate, they're not going to borrow because it's going to turn them upside down. And so that's something that's been interesting, is that you've hit a ceiling on some businesses where you just can't charge anymore because their assets just don't support that type of lending. So in certain areas of the market, what you saw particularly in 2022, spreads on direct lending really didn't move out to the same degree that you saw spreads on, say, broadly syndicated loans or high yield move out. And a lot of it is around that idea that they were charging their borrowers about as much as they could charge them without turning them upside down. And so what you saw is it wasn't that spreads came down; they just stayed relatively flat. And again, that goes to this idea that in private credit as well, you don't see a lot of changes in terms. It tends to be relatively steady, and that's on when spreads are moving out in the public markets, and that's when spreads are moving in the public markets. And so that's an interesting dynamic there that occurs. So I'd say that overall, what you're going to see is public market spreads will move around. private market spreads are not going to move around nearly as much. So what you see sometimes then is that the spread between public and private can compress, particularly when spreads are moving up in the market. And we did, and that has occurred, particularly again in this middle market direct lending space. The spread versus your broadly syndicated loans or your high yield loans has compressed, and that's something that definitely has occurred over the last few quarters, and it's made that yield pick up a little bit less so. If spreads then move in the public markets, you're not going to see the private markets spreads move in nearly as much, and then you're going to see a decompression.
Because fundamentally, you would think that risk premia increase in a high rate environment because the underlying companies will more likely be struggling, and therefore the spread should increase actually. But yeah, you make it very clear why that just can't be the case.
It just hasn't occurred. I'd say nearly to the extent that they would have thought so. Yeah.
Yeah, and does that mean that the asset class of alternative credit is less attractive in high rate environments then, because you do have like the option of safer investment is yields more, so the difference between that decreases in terms of returns?
So I don't think exactly that. I mean, I think from a yield differential standpoint, that yield differential does compress a little bit. The one thing though we did see is that the lenders, yes, they can't really charge much more, but what they actually did instead is that they put in tighter covenants. So if you look at, there's various ways to measure, how many covenants are in a loan document, or what percentage have maintenance covenants. There's these indices that track that. And what you saw during that time period when rates were moving up and private lenders were not increasing spreads, is that they tended to write their loan documents a lot tighter. So they basically traded off greater spread for more downside protection. And that's a lot of what we've seen anecdotally across the industry, is that a lot of groups, they increase rates, floating rates increase. So, or your base rate increases. So the overall interest rate on your loan increases. But a lot of the loans that were underwritten during that time period were a lot tighter. And so because you're in the private markets, you have that ability to really, shape those loan documents to the point at which you're comfortable.
When we think of rates over time, then, with more shops coming into this space, more people want to put in money, has that compressed spreads or yields at all in this space?
Yeah, I there is some dynamic. A lot of what we've seen, is again, sticking to that middle market direct lending side. A lot of what's happened is it's come from the broadly syndicated leveraged loan market, which I'd view as a public market, and it's migrated into the private markets. And so a lot of the deal flow has gone there. It's essentially moving from one hand to the other in many ways. So yes, there has been, I'd say, almost a little bit of a gray area now between some parts of the private credit markets and the public markets, in that borrowers are shopping around. They're playing the public markets off of the private markets and getting better deals. So there is some dynamic there that I think that the greater capital that's floated come in, maybe that will compress some of the spreads. It has a little bit. That's where I'd say, from an investor standpoint, from an LP, really one of the things I would stress to focus on is talking to GPs and understanding their sourcing advantage, understanding how they're able to bring in loans and originate them, maybe off market or just away from where the whole masses are. You don't want to be originating loans when there's 25 other term sheets out there, and you're usually going to get the deal because you have the looser terms or the lower spread that's in there. So I think that the sourcing advantage is going to be a big area of focus in the alternative lending space over time. that's an area that I would expect more lending platforms to spend more money on, is to be able to source directly with borrowers, and be able to reach them, whether that be through smaller loan balances, digital marketing. A lot of groups have started to spend a lot of money in digital marketing. That you wouldn't think about that. They've hired entire marketing departments to be able to get out there and source these loans away from some of the competition. So that's going to be a big trend, is ensuring that when money flows into the market, you're not affected, or you're less affected. You have that sourcing pipeline that's your own, and it's something that you control.
So we might get the impression that there's so many more people doing alternative lending and lending to companies generally. Really, it's got to be flush with all this credit now. But that's because it shifts to a segment that caters more to us direct investors, as well as and therefore just advertises more, right? That about what they're doing.
Yeah, exactly. Yeah. So a lot of the money that's flowing in has been in that middle market direct lending space, which is essentially a cousin of broadly syndicated loans. So a lot of that has just been taking the same borrowers, more or less, moving them to the private side. But I think that the sourcing advantage and the sourcing capabilities, and where you see the really defined sourcing networks, is outside of that area. It's more in the specialty finance space. It's in the venture capital lending side of things. It's really outside of your typical, your larger cap area of the alternative credit space.
So a broad chunk of our viewerships here will be young, newly minted CFAs. Hearing this, they're gonna want to get into the space. They probably already thought about it, and that's why they're listening. Any advice that you would give to people wanting to enter this space, probing and looking for opportunities?
Yeah, I mean, I think it's an interesting space. I think it's going to grow. There's a lot of people, a lot of those newly minted CFAs, they were looking to get onto bank bond trading desks before, and a lot of that has moved to the private markets for many of the reasons we talked about before. So it's really a natural progression of the fixed income markets has been to move on into the private side of things. And so, if you want to get into the space, I'd say, read as many investor letters as you can. They're out there. There's a lot of groups, there's BDCs that publish their investor letters. There's private funds that'll invest that provide their investor letters. It gives you a good flavor for what people are looking at and what they're doing on a day-to-day basis. The other thing as well, to the extent you can, I think one of the best ways to learn the space is reading through loan documents. And some of them are out there that you can find. There are some public companies that have gone to the private credit space. Read through the loan documents, get a sense of how these things are structured. That's I'd say a good way to just understand what the risks are, how people look at the space, how they think about it. It all comes out and is written on paper at the end of the day. So I think that's a good thing to look at as well. And then don't be shy. I mean, I think it's a growing space. It's something that people are very friendly. You'd think that these are lenders; they're going to be have these sharp elbows, but they're always willing to talk. So reach out over LinkedIn, talk to whoever you can. People are willing to share their insights on the space. So I'd say that about all areas of the market, but private credit, because it's growing, changing on a constant basis. The people are always willing to swap ideas and just leave what they do.
Well, thank you so much. Yeah, I certainly enjoyed this conversation. I've taken away that this is a space where a lot of interesting innovation and a lot of dynamism. So way more than in many other parts of the finance world, for sure. So that's really interesting. And I'm sure there have been a lot of other things that we've touched on that our listeners have taken away as well. And just to wrap up here, and again, thank you for coming on. Maybe you can tell our viewers here a little bit more about the Alternative Fund Advisors, what you do there, as well as how people may connect with you.
Yeah, definitely. Yeah, so Alternative Fund Advisors is a SEC registered investment advisor. So we manage the AFA Private Credit Fund, and so that is focused on multi-manager private credit with a particular focus on asset-based lending and particular focus as well on small balance nichier type areas of the private credit market. That's an area that continually evolving and changing. So it's something that we think is particularly interesting. The fund is structured as an interval fund, so it's particularly focused on advisors and independent advisors here in the U.S. You can find us at alternativefundadvisors.com.
Great. Thank you so much, Mike. And thank you, everyone listening for tuning in to the Financial Thought Exchange podcast. This has been Lotta Moberg, your host, and with us was Mike Dowdall, our Alternative Fund Advisors. And we'll see you again soon.